This question tests students' understanding of the primary purpose and uses of published financial statements. Annual reports prepared for shareholders contain the statement of financial position, income statement, cash flow statement, and accompanying notes, which provide information for external stakeholders to assess profitability, liquidity, solvency, and future prospects. The key phrase is least useful, meaning students must identify the group that relies least on these published reports because it already has access to more detailed internal information. Stockbrokers. Incorrect. Stockbrokers use annual financial statements to evaluate company performance, estimate firm value, and advise investors on buying or selling shares. Therefore, the reports are highly useful to them. B. Bankers preparing to lend money. Incorrect. Banks examine financial statements to assess creditworthiness, debt-paying ability, liquidity, and financial risk before granting loans. Consequently, these reports are an important information source. C. Competing businesses. Incorrect. Competitors often analyze published financial statements for benchmarking, market analysis, cost structures, profitability trends, and strategic planning. Although limited, the information is still valuable. D. Managers in charge of operating activities. Correct. Operating managers typically have access to internal management accounting reports, budgets, operational KPIs, and real-time performance data that are far more detailed than published financial statements. Therefore, the annual report prepared for shareholders is least useful to them. Correct answer. D. Managers in charge of operating activities. Exam tip. Published financial statements are designed primarily for external users, investors, creditors, regulators, analysts, and competitors, while internal managers rely mainly on management accounting information for planning, controlling, and decision-making. This question examines the accounting and financial statement effects of disposing of a fixed asset at a price below its book value. Students should recognize that book value equals cost minus accumulated depreciation. If the selling price is less than the book value, the company records a loss on disposal, which is recognized as an expense in the income statement. The key phrase is will decrease, requiring students to identify the financial measure directly reduced by the transaction. A careful analysis should distinguish between the impact on profitability and the impact on liquidity or working capital. A. Total current assets. Incorrect. Current assets may increase or decrease depending on the cash received compared with the asset previously held, but the sale itself does not necessarily reduce total current assets. B. Current ratio. Incorrect. The current ratio, current assets divided by current liabilities, is not necessarily reduced. Its movement depends on the amount of cash received and whether current liabilities change. C. Net profit. Correct. Selling a fixed asset below its book value creates a loss on disposal, which is recorded as an expense and reduces net profit for the period. This is the direct accounting consequence of the transaction. D. Net working capital. Incorrect. Net working capital equals current assets minus current liabilities. Since current liabilities are unaffected and current assets may simply change form, fixed asset to cash, net working capital does not necessarily decrease. Correct answer. C. Net profit. Exam tip. Always compare the selling price with book value. Selling price, book value gain increases profit. Selling price, book value loss decreases profit. This question tests students' understanding of accrual accounting and the timing of recognition of transactions. The company signed a rental agreement on July 15th, but the machine will not be delivered until August 1st, and the first rental payment is due on August 1st. The key issue is whether the signing of a contract alone creates an accounting entry at July 31st. Under the accrual principle, Transactions are recognized only when an asset is received, a liability is incurred, or revenue or expense has been earned or incurred. Simply entering into an executory contract, a contract that has not yet been performed, does not normally affect the financial statements. Cause no change in assets, liabilities, or income. Correct. As of July 31st, the company has not received the machine, made any payment, or incurred rental expense. The contract is merely an agreement for future performance, so no journal entry is required, and the financial statements remain unchanged. B. Increase both assets and income. Incorrect. No asset has been received and no income has been earned. Therefore, neither assets nor income should increase. C. Increase both assets and liabilities. Incorrect. Although a contract exists, the company has not yet obtained control of the machine or incurred an obligation requiring recognition under normal accounting principles. D. Increase liabilities and decrease income. Incorrect. No rental expense has been incurred before August 1st, so neither liabilities nor expenses should be recognized. Correct answer. A. Cause no change in assets, liabilities, or income. Exam tip. Merely signing a contract does not create an accounting entry. Recognition occurs only when goods or services are received, obligations arise, or economic events affecting the financial statements have actually occurred. This question tests students' understanding of the limitations of the statement of financial position, balance sheet. The word except is critical because it asks for the option that is not a limitation of the statement of financial position. Students should distinguish between issues related to the balance sheet and those related to the income statement. The statement of financial position reports assets, liabilities, and equity at a specific date, but it has several well-known limitations, such as reliance on historical cost, accounting estimates, and the exclusion of many internally generated intangible resources. Therefore, students must identify the choice that does not describe a balance sheet limitation. A. Quality of the earnings reported for the enterprise. Correct. The quality of earnings refers to how reliable and sustainable a company's reported profits are, which is primarily an income statement and earnings analysis issue, not a limitation of the statement of financial position itself. Therefore, this is the exception. B. Judgments and estimates used regarding the collectability, salability, and longevity of assets. Incorrect. Many balance sheet amounts depend on management estimates, such as bad debt allowances, inventory write-downs, and useful lives of assets. This is a genuine limitation. C. Omission of items that are of financial value to the business, such as the worth of the employees. Incorrect. Valuable internally generated resources, including employee expertise and human capital, are generally not recognized as assets under accounting standards. This is a limitation. D. Lack of current valuation for most assets and liabilities. Incorrect. Many assets and liabilities are measured using historical cost rather than current market value, reducing the balance sheet's relevance for valuation purposes. Correct answer. A. Quality of the earnings reported for the enterprise. Exam tip. The balance sheet's main limitations involve measurement, estimation, and omission of unrecognized assets, whereas earnings quality relates to the analysis of reported profit rather than the statement of financial position itself.